sharpest macro analysts in the world says global liquidity may be peaking, whilst everyone else is saying we just need to be patient. What if he's right? What if Bitcoin really is the purest liquidity barometer we have, and it's telling us something the charts can't hide? The same thing it's shown us at every single peak. The question is, did liquidity peak, or is the cycle about to extend? This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Hey guys, I'm Alessandro. Welcome back to the channel. Let me set the stage. There's a framework I've been studying from a researcher named Michael Howell. He's considered the godfather of liquidity, and he tracks something called the Global Liquidity Index. This is a specific factor that he has made, and it's the total funding capacity across the entire financial system, and it's been going for over 30 years. That liquidity moves in cycles, and they're roughly every 65 months. The current cycle bottomed in October 2022. Global liquidity is at $186 trillion. That's 14 trillion higher than last year, but the momentum is dying. The 3-month annualized growth rate just dropped to 1.3%. The tide is high, but the waves, they might be fading. And now, is he right? Let's look at the evidence, and then I'll show you what could potentially prove him wrong. This chart is absolutely fascinating. This is taking Michael Howell's Global Liquidity Index and overlaying it on Bitcoin price action. Michael Howell's liquidity index is slightly different to the ones that you can find in TradingView, so I had to make it in here. If we overlay global liquidity onto Bitcoin price, this is Michael Howell's index, what you can clearly see is that generally global liquidity goes up, generally Bitcoin goes up. Nothing too dramatic. If we add on the Bitcoin peaks here, what you can see is that every time Bitcoin peaks, it actually peaks before global liquidity peaks. In 2017, Bitcoin peaked first. Look at this high here. Global liquidity peaks, a few months later. The same thing happened in 2021. Bitcoin peaked, global liquidity peaked a few months later. You can see this divergence here. We had this previous high here back in October, the Bitcoin peak, global liquidity index has continued up. And this is where things get really fascinating. If we overlay the global liquidity rate of change, so if we get rid of global liquidity, and now we're just looking at the rate of change, this is the key. Michael Howell's thesis is that global liquidity has looked like it's almost flatlined. It's coming into its peak, whether it's at its peak or it's in the process of peaking, but the rate of change, how much it's changed in the last 3 months, is dramatic very recently. You can see this massive cutoff here. But what you can see in this chart, which is just so interesting, is that Bitcoin peaks when the global liquidity rate of change begins to drop off. You can see here, the global liquidity rate of change in 2021 began to drop off. It was the peak of Bitcoin. In 2017 as well, Bitcoin peaks, the global liquidity rate of change already came down. It had already began to decrease. And right now we can see this global liquidity rate of change just ticked down at exactly the same time Bitcoin peaked. Let's start with the case that liquidity has in fact peaked. What is the evidence? First off, we've got the timing. The 65-month cycle is measured from trough to trough. October 2022 was the trough. If you add 65 months to that, the next trough is around March 2028. That means the peak roughly halfway through should fall somewhere between mid-2025 and early 2026. According to Howell's daily nowcast data, momentum peaked around August 2025, and that lines up almost exactly with the Bitcoin top at $126,000. If we look at the growth rates, the 12-month growth rate in terms of liquidity is 8.1%, which sounds incredibly healthy. However, that's mostly a base effect. We're comparing to weak late 2024 numbers. The 3-month annualized rate, which is like a real-time signal, it tells you what's really going on, has just dropped to 1.3%, which tells you liquidity is peaking. It's beginning to decelerate. The engine is slowing down. And if we look at what central banks are doing around the world, Japan has been running aggressive QT. In 2025, their balance sheet shrunk by 148 billion just in Q3 alone. They have announced they're going to slow down starting April 2026, but through Q1, full speed ahead. The European Central Bank is putting over $500 billion of securities back into the market in 2026, and their balance sheet is shrinking by 11% year end. Between Japan and Europe, you've got combined liquidity drain that's very real and ongoing. But Bitcoin already sniffed that out and reacted. There's typically a 3-month lag between liquidity changes and Bitcoin price action. Bitcoin tends to lead where liquidity follows. And in Q3 2025, liquidity momentum peaked. Q4 2025, Bitcoin topped at 126K, then obviously dumped down to 90K. 2025 was a down year for Bitcoin for the first time since 2022. And this is incredibly interesting data. It takes the year of the presidential campaign, so first year, second year, third year, fourth year, Obviously, the first year is the inauguration year, the second year is the midterm year, the fourth year is the re-election year. And it says, okay, what were the gains in the SPX and how much were the earnings per share in those years since 1970. What you can see is that in the midterm year, the second year, which is the year we're in right now, typically the gains in the S&P 500 are pretty bad, less than 1% relative to almost 10%, almost 17%, about 11%. However, the earnings per share gain in that same midterm year are the best. This is really interesting because it sort of is opposite to what you would imagine. You'd imagine, well, the best years in terms of stock prices are going to be the best years in terms of earnings. But they're not. They're completely opposite. And this maybe even leans into Scott Bessent's latest approach of trying to prioritize Main Street for 2026, not Wall Street. He said multiple times, Wall Street have had their turn, Wall Street have had their turn. We are prioritizing Main Street from here. And so maybe that's setting us up for another year where the gains in the SPX are weak, but the earnings in the SPX are really strong. Now, the case against liquidity dropping, on December 10th, the Fed announced something called reverse management repurchases. Essentially, they're going to be buying $40 billion in treasury bills every single month. Over 12 months, it's expected to be $480 billion in purchases. Now, of course, the Fed insists this isn't QE. They're calling it technical, just plumbing, maintaining ample reserves in the banking system. But when the Fed buys securities, the balance sheet expands. This is, of course, a huge material change, and the Fed went from draining liquidity to neutral to now actively adding liquidity. But in 2019, when they did exactly the same thing, Bitcoin price didn't immediately reverse. In fact, it took quite a long time, 6 to 9 months, before we really started to see any reversal in Bitcoin price action. And arguably, it started to reverse because of the bazooka stimulus that was implemented from COVID. We also have China. At the annual work conference last week, the PBOC announced they're maintaining a moderately loose policy for 2026, interest rate cuts, liquidity injections to support growth. So expectations in China are a 25 basis point cut, followed by more cuts potentially in Q2. Another thing to consider, and this is subtle but important, is the MOVE index. This measures treasury bond volatility. You can think of it like the VIX, the volatility index for bonds. The MOVE peaked at 137 in April. It's now around 65, which is a massive improvement. This is a tailwind that could offset some of the central bank tightening coming from outside the US and China. And fourth, the dollar. The dollar has been weakening against the euro, the pound, and especially the yuan. And a weaker dollar is positive for global liquidity. It eases financial conditions outside the US, makes dollar-denominated debt easier to service, and encourages cross-border flows. So if the dollar continues to weaken, that's another tailwind for global liquidity. Now, interestingly, global liquidity is priced in dollars, which means if the dollar depreciates against other currencies, global liquidity ticks upwards. That isn't really any extra money in the system, it's just the dollar being worth less. So what scenarios have we got? The first, peak holds. The Fed's RMP is too small to offset the BOJ, the ECB, and China's easing is too gradual. Momentum continues to fade. Scenario 2, the cycle extends. Maybe we push higher. The peak gets pushed out to Q2 or Q3, maybe even later into 2026. Risk assets get another leg up. In this scenario, Bitcoin is likely to rally much higher. Or scenario 3, something breaks, the Fed panics, labor markets crack, repo stresses return, financial accident forces the Fed's hand. They move from RMP to full-scale QE, balance sheet goes vertical again. In this scenario, liquidity explodes higher, but it's a crisis response, and the rally comes with massive volatility and economic pain underneath. So the things we're watching to see which plays out: Fed balance sheet. Is the RMP enough? What if they increase repurchases or start buying longer duration securities? This would signal escalation. The People's Bank of China's actions. Watch for the actual cuts. Direct credit from China. If they go bigger than expected, that's bullish for global liquidity. The Bank of Japan, they said they'll slow QT from April 2026. Will they pause it entirely? A dovish shift from Japan would actually be a big deal. The MOVE index too. If bond volatility begins to spike back above 100, that signals collateral stress is returning. That's a canary in the coal mine for liquidity to be crunched. The data's conflicted and we're at a crossroads. Michael Howell thinks liquidity is peaking. One thing is clear: the economy looks like it is not getting stronger yet. The PMI came in again down, signaling yet more contraction. Labor data continues to look weak with unemployment rising. 2025 was the worst year for jobs added since 2003. So does the peak hold? Does the cycle extend? Does something break? Let me know what you think in the comments. Bear markets are where the best returns are made. So regardless of the outcome, losing interest because Q1 or Q2 are lackluster is just about the worst thing most people end up doing. For me, I just DCA the tokens I like weekly, I have deep conviction in, and I think will survive deep market downturns. Guys, before I go, just a massive shout out to Uphold for sponsoring today's video. Uphold is a long-running digital asset platform offering access to crypto, stables, and traditional assets all in one place. They've been operating for over a decade. They support a broad range of assets and put a strong focus on transparency and operational disclosure, including publishing reserves and balance data that many platforms still do not. One of the most annoying frictions in crypto is moving value from on-chain assets into everyday spending, which can involve multiple steps and counterparties, and it's always a hassle. 𝗕𝗘𝗦𝗓 offers a payment card that allows supported balances to be spent directly. Crypto is highly volatile and unforgiving. You could lose all of your money. There's no safety net and no one will protect you from bad decisions. Only get involved if you understand the risks. Don't invest money you can't afford to lose. Thank you so much to 𝗕𝗘𝗦𝗓 for sponsoring the video. Thanks for watching, and I will see you next time.